This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So on today's episode, we had Dr. David Blitzer, and he's not exactly a household name, I don't think. I'll be surprised if anybody listening knows who he is. He is the managing director and chairman of the S&P Dow Jones Index Committee.
Just think about that. He is the managing director and chairman of the S&P Dow Jones Index Committee.
That's S&P like the S&P 500, Dow Jones like the Dow Jones Industrial Average. Like he's the guy at the center of indexes.
He's been at the center of the index revolution for the past...
I think 1982 is when he started at
past
S&P?
30 plus years.
So he's been there from the time when indexes were barely even being traded. Like the first time S&P Futures began trading, he was there, right?
Mm-hmm.
Yeah, he was at S&P at that time. And then from there, indexing's obviously turned into this massive thing. And S&P indexes, as everybody should recognize that's listening to the podcast, are at the center of that explosion.
Yeah, and S&P took over Dow Jones. Now they're all one. So the Dow Index, and he talks about this, goes back very long time, as does the S&P 500. So we had a fascinating conversation with him. Brilliant guy, graduate of Cornell University, MA in economics from George Washington University, and a PhD in economics from Columbia. He's retiring this summer, so we're super lucky to have the chance to meet him and get to ask all the questions we wanted. He was so gracious.
So gracious, so chilled out, laid back.
Right from the S&P headquarters down in Lower Manhattan, overlooking, it was pretty surreal experience for us index lovers.
We were in there looking around, we asked him, this is it? This is where the indexes are made? And he's like, yeah, this is it.
And it was pretty impressive. He was a very impressive, very, very nice guy. And we're very thankful that he was willing to spend time with us.
But talk about insights on indexing and indexes. Who else could you ask? I mean, one of the questions that stood out to me was, I asked him, where do you draw the line between active and passive when it comes to indexing? And we all agreed that we don't like passive as a name for index investing. But anyway,
he called it intelligent investing.
Yeah, he said that name never stuck. But anyway, his answers to every question that we asked were insightful and very thoughtful. And like we said, I'm getting excited talking about it. This is he's the guy. He was there for all of indexing.
Yeah, we're super lucky to have him for our listeners. And yeah, it's a pretty cool interview. So episode 54, hope you enjoy it.
Dr. David Blitzer, welcome to the Rational Reminder Podcast.
My pleasure to be here.
We're thrilled to have you because you're nearing your retirement. So this is a lucky get for us.
Very good. Well, it's a good chance to look back and what's happened and maybe even look forward a tiny bit.
That's great. So you've been there in terms of being there for indexing from the very beginning.
Well, actually, the very beginning of the S&P 500, I think, was about 1926. I wasn't here then. But if timing is everything, I guess I'm not lucky. I joined S&P in the beginning of 1982, about 6 weeks after futures trading and the S&P 500 started. And in terms of the modern era of indexing and index funds and investing with indices, that's really the beginning of the modern era.
Right. So what's changed? I mean, from the S&P futures until now, what's changed with indexing in general and index investing specifically?
I think there's been a huge change. Back in 1982, or around then, indexes were really to sell newspapers. The Dow Jones is the most obvious example. S&P historically was a financial publisher, and that's where the S&P 500 came from. The idea that you could invest with an index, you could do it with the Vanguard fund by then, but very few people paid any attention to that, and the assets were minimal, if not. And it's really expanded. I mean, the institutional investors learned about it with the 500 because all of a sudden they could use futures to hedge their portfolios. And that was a huge change that they couldn't do before. The rest of us, all individual investors, began to learn about it, especially in the tech boom in the 1990s. There were a couple of months or a couple of quarters where the S&P 500 outperformed something like 95% of all the mutual funds in the United States. It shouldn't happen. And it happened because of the technology boom and the market cap weighting in the index. And then roll forward, you got ETFs, which while they were created in about 1993 in the US and a little bit earlier in Canada, they didn't really get going until the early 2000s when a big marketing effort by what was then called Barclays Global Investors and now BlackRock really decided to sell it to everybody like you and me. And that just took off. And then you could invest in an index. You didn't have to figure out which index mutual fund was doing it, where to get a hold of them, and how to send checks to them. Just called up your friendly broker, whomever he was, wherever he was, and he sold you an ETF. And I think that's what really put the game on high growth at that point.
I'd like to ask you a very basic question. Can you just explain the relationship, say, between S&P and the product manufacturer like a Vanguard? Just explain the different roles at a basic level.
S&P Dow Jones indices is what we call an index provider. We design, develop, and calculate an index, the S&P 500, Dow Jones Industrial Average, and literally a few 100,000 additional ones. We don't run an investment funds. If you send us a check, we're going to send it back on cash because we don't do that business.
Right.
We're not a registered investment advisor. We're not a broker dealer. We're not any of those. We're strictly a publisher of indices and so on. A Vanguard, BlackRock, State Street, on and on and on. What they do is they license an index fund, and they license an index from us. So they license the use of the S&P 500 from S&P, and then based on that license, they issue either an exchange-traded fund or a mutual fund that tracks the index.
And that gives them the right to use the brand name, and then they have to follow exactly their mandate is to track as close as possible to the underlying index.
Well, typically the agreement doesn't put an absolute restriction on how close they can track and so on. And it depends on, first of all, how big their fund is going to be, how they're structured, how they're viewing it, that kind of thing. They license the use of the name, and they also receive data from us on every night for any index somebody like Vanguard or State Street is licensed. They'll get two files. First file will show you exactly what the index looks like as it closed tonight, including the closing prices, all the weights, all the securities, anything else in it. And a second file, if we're making any changes overnight, adding a stock, dropping a stock, the second file shows you what it's going to look like tomorrow morning when the market opens, and so on, so that you can compare the two and figure, I hope I sold this one and bought that one, kind of thing, and so on. So that's what we do. We obviously promote, tell people about our indices and so on. And since the product issuers, the State Streets and the Vanguards, usually use the index name and the name of their product, we benefit and they benefit and so on.
Naturally.
Are there major differences between something like the S&P Total U.S. Market and the CRSP 110 in terms of construction? Is that too technical of a question?
No, I don't think so. There are probably a lot of subtle differences the way the indices are run and so on. There's the basic data is going to be the security price, the names, companies, and then there are a whole set of rules on how you choose or select the companies. For example, the S&P 500 and a few other our indices require that the company be profitable at the time it's added to the index. And we're sort of traditionalists. We look at generally accepted accounting principles. All these more novel ways to figure earnings are very nice, but they're not for the index. That's not too common. So one big difference between the S&P Small Cap 600 and the Russell 2000 is they don't have a profit screen, and we do. And we've got years and years of research that suggests that it makes a difference in the performance to the benefit of the Small Cap 600. And there'll be other kinds of issues, differences as well. The exact security selection, maybe the timing. A lot of indices make changes on a sort of schedule, once a quarter, once a month, Russell once a year. For the 500, the mid-cap 400, the small cap 600, we do it what we call an as-needed basis. If stock is going to be merged out of existence the middle of next week, sometime this week, we would have made an announcement after the market closed, tell you what we're going to do. We'll make the change then. We're not going to run an index with short one stock until the end of the quarter.
So you've seen an explosion in the popularity of index investing. Any thoughts on what the main cause was, what the main tipping point was?
Yeah, I don't think there was really a tipping point. It's not like I can think back and say, aha, that was the day it all happened.
The creation of ETFs or...
I think ETFs are probably the biggest factor, not just the creation, but really the mass popularization of them and that kind of thing. One factor is that, as I think I mentioned, you can call up any broker and buy an ETF. You don't have to go to the particular fund company and that kind of thing. And that meant that instead of having to go to Vanguard for an index fund or go to Fidelity for a Fidelity fund, you just go to your broker, whoever it is, and you say, here's what I want to do. And you do it. So Vanguard, instead of having just their salespeople or Fidelity, their salespeople, now they've got every broker in the country out there. And that's made a huge difference. On top of that, you've got online investing. You've got, certainly in the United States, the demise of defined benefit pension plans. Unfortunately, they're vanishing like crazy. The rise of 401k plans, all kinds of defined contribution plans, any kind of sort of packaged investment, the ETF turns out to be ideal. And so-called robo-advisors is probably the current version of this trend. And it seems to be just building and going. On top of that, ETFs have created a massive price war across the entire investment community. When Jack Bogle passed away, I saw one comment that more investors owe him more money than anybody else in the history of the world. And it's probably true. In fact, I'm a beneficiary of that. I have money in Vanguard funds too. But I think that's definitely helped. We increasingly hear of modest-sized institutional players who 20 years ago either ran the money in-house or would contract with a State Street or BlackRock to run the money. Now they just buy an ETF.
Really?
And the liquidity's there. You want to move money in and out quickly. You just want the money to be earning something in the stock market instead of sitting to the end of the month when you make payments. You buy an ETF.
Plus, the evidence is there too.
Yeah. So,
what do you think about the role of the data in this shift to indexing? Like, obviously, there have been numerous academic research papers, the efficient market hypothesis, which sort of started all of that. But then Standard & Poor's publishes the Spiva report twice a year. Like, how much of a role do you think that's played in people saying, well, active's clearly not working that well?
I think it's been a pretty big role. And I don't think it's that big an impact for individuals as much as it is for small institutions. When our people go out and talk to things like state and local municipal pension funds, and this is not like New York State with literally billions of dollars, but this may be the police and firemen of whatever middle-sized city you want to mention. These groups don't really have the wherewithal to hire a lot of fancy consultants or to have a huge analytical staff and so on. And you usually get, 3 policemen and 2 firemen on the committee, and who, they're very knowledgeable. They know what they do, but they're not, they're probably better at investments than I am at fighting fires, as a matter of fact. But you show up with a Spiva report, the numbers are all there, and it's nicely laid out. And we've now got, I think it's about 15 years history in the United States. It makes a pretty good argument, and so on. And people say, do they really work? And I say, well, 3 out of 5 funds aren't going to beat the index. And as a matter of fact, none of those may repeat next year. So it's not a great bet in the long term.
A lot of people call index investing passive investing. We personally don't like that term. So I'm curious on your perspective on that, being a lead, and you can maybe talk about your role as well on the S&P Index Committee and how that process works.
Well, the first thing is, I used to try and call it intelligent investing. I like that better than passive, but I'm not sure I got that term to stick to anybody else. But I think the first thing to say about the Index Committee is it really is a committee with a group decision. I mean, the number varies slightly. It's probably never been lower than 6 or 7. I don't think it's been much above 10 over the years. Everybody gets one vote. So, I mean, when I was chairman, I lost some votes too, or I was on the minority side, if that's the way to put it. And one sort of policy or tradition or something was you didn't want to end discussion, or discussion went on and there was clearly disagreement about some topic. I would just say we'll go around the table, meaning everybody has to get a chance to say something. He can say, well, I agree with the last guy, but nobody should complain they didn't get their 2 cents worth to put in. And the committee, the committee would review what's going on in the market, review what the index look like, look at pending corporate actions, mergers, acquisitions, spin-offs, whatever that are happening. We track the news continuously, which means that at any moment, we probably know of all the mergers that are going to close within the next 6 to 9 months, because that's how long it takes to close a merger from announcement on out. And the committee constantly is looking at the index and how it's behaving. Probably the most important thing is the index objective is to track the large cap segment of the U.S. stock market. The committee's job and objective and responsibility is to make sure the index does that. So the committee is not a stock picker in the sense of, I like IBM better than Dell, or, that's not the question at all. And the question is, do these 500 stocks, do they meet the requirements for size and liquidity and so on? And are they the right 500 stocks to meet the objective? We're not picking stocks to make it go up, picking stocks to meet the objective that we publish.
Is it hard to keep your opinion out of that so that it does not become an active?
Well, I think first of all, none of us committed to own any stocks. So it's a different. We don't have any skin in the game in that sense. I mean, clearly we have skin in the game. There's a bear market. Everybody calls them, blames us. We can't change that. We can't prevent a bear market. We would have done it a long time ago, obviously. He'd tell you exactly when we would have done it, or we could have done it. If I think back of the people we've hired, and was a period going back, I guess, prior to the late 90s, when we actually had a separate department in S&P, not tied in index at all, but a separate department that had equity analysts and so on. And right around the time I became a little work in indexing, I was still running part of that department. So but people who want to be analysts and pick stocks are different than people who want to run indices. And this is a different mindset and so on. Somebody who thinks he knows the latest hot stock or why Uber is a better IPO than Lyft and that kind of stuff. He's not the kind of person, or she's not the kind of person who's going to gravitate toward indexing. They're going to gravitate to picking stocks or, working in a hedge fund or something. There's nothing wrong with that. I mean, we've, over the years, we had a couple of people learned a lot of indexes, but then decided they know how to beat them consistently. They went to a hedge fund, I wish them well, I guess is the right way to put it.
So here's an interesting question. You're not trying to build the S&P 500 to be an active fund that performs well. Why is it so hard to beat that?
I guess there are 2 or 3 theories and stories and so on. First is the cost. I happened to call up a bank and ask them what they charge to buy U.S. Treasuries, and they quoted me several basis points as the fee. And when I sort of got over the shock, he said, wow, that's not so high. And I looked at him and said, I buy a portfolio of 500 stocks. It cost me about 3 basis points. So, anything more than that for U.S. Treasuries is ridiculous. So the cost is definitely number one. There's I don't remember exactly who the argument is, but if you look at the whole market, the whole market is indexed and so on. So there's some winners and some losers. You take only part of it and that kind of thing. But I think the other thing is, if you look at the stocks in the S&P 500, look across the whole 500 stocks, how they did in a year. And obviously, some did not very well and a few did very well. But it's skewed to the extreme right-hand side. So if you as an active manager, if you own the 6 or 7 stocks in the extreme right-hand tail, the ones that probably returned 6 times what the index overall did, you'll be in Fat City. But the chances are you own those stocks, even on a random selection basis, not very good. If there are 5 stocks out there, you got about 1 of 500 chance that's in your portfolio. If you own the index, you own all of them, and so on. And over time, there's few stocks at the end and the tail that account for the lion's share of the performance in any given year, and so on. So I think that's what's really doing it. Is if you're in the index, you through your fund or whatever, you're going to own something of both. That also is part of the reason why the equal weighted version of the 500 seems to do so much better than the cap weighted version over the long term. Because if those 5 stocks out in the edge, the best performers, happen to be numbers 496 to 500 by rank in the 500, their cumulative weight's maybe 1%.
Right.
Whereas at the equal weighted, know exactly what it is.
That's really interesting because that does give you a higher weight for potentially in a stock that does really well, as opposed to being like a value story or a smaller cap story. Like it's not really a factor story, the equal weight then on the S&P 500.
Yeah, I mean, the equal weight also benefits. I think it benefits from the fact that you're upweighting the smaller stocks and downweighting the biggest ones. And I mean, we had a sort of a pretty active debate about in the office about a year ago. Some people see small cap means it's just small caps, small stocks and nothing else. And I said, no, I think it's a continuum. I mean, and so if I take the bottom 100 stocks out of the 500, I'm getting some small cap benefit, even though the smallest stock may be $6 billion in market value or something. The other thing is that value stocks tend to be lower price and growth stocks tend to be higher price. And so I'm getting the equal weight overweights the value as well. But I think the skew is a big part of the story in both cases.
Yeah, it's really interesting. What do you think? Obviously, we've talked about the explosion of index investing and the data and the SPIVA report and all that kind of stuff. What is the effect that has had? Or what do you think the effect that has had on traditional stock picking and market timing, traditional active management?
Glad I'm not in that business, I should say. I guess it's done a few things. It wouldn't surprise me if it's encouraged a few people who used to just be active stock pickers to decide they're going to be hedge funds because they can claim bigger fees. And I did many years ago meet one fellow. I mean, this was probably 15 years back and so on. He said he was, sort of rearranging his business. He was no longer a money manager, now a hedge fund. And I said, why? And he said, well, you'll pay me more. So he was an honest guy, obviously. But as I look across the range of active managers and so on, and I think there are some who I guess usually get called closet indexers. They sticking relatively close to their benchmark. And there's some line about, it's often being better to be conventionally wrong than unconventionally right. And and if the way their contracts are written that makes a point, then that's a logical thing for them to do. There are some of the hedge fund, and I think there are a handful of traditional active managers that are out there. I always noticed articles about Bill Miller because he had a record of beating the 515 years in a row, and my hat's off to him. Toward the end of that span, in his letter to his shareholders or his investors, he announced that the best proof of active management was the index committee at S&P running the 500, which was a nice compliment, but I don't think it was accurate. But there was a thing in the Wall Street Journal over the weekend, a very short interview with him. And he made some of the same points that there are active managers. His target or his style, as he described it, is to have a large active share. He doesn't stick close to the index or the benchmark, whatever it is. And he knows he's taking big bets. He's obviously got a good track record of taking big bets. Unfortunately, there's another British portfolio manager been in the newspaper lately who took the wrong big bets. But I think in the long term, there'll always be a small group of people, some like Bill Miller, who really have skill, who really demonstrated the skill. And I'm sure everybody has their ups and downs. There are always people who think they can do it, whether they can or not. But the other thing is, with, say, the S&P 500 was a huge chunk of the game at this point. Any change that's made to the index is announced 2 to 5 days in advance. The rules about that index are published. They're on our website. You can pull them down. The history of the index going back to 1920-something or other is available on the web. You can't go through the rules and know exactly what stock will be the next one chosen or something like that. But you get very close. You want to know when it's going to happen, just follow the mergers the same way we do, and so on. So all that information is out there. And if successful active management depends on a lot of information, well, it's there. So, and I presume there'll be people out there who harvest it and put it to use. So indexing is never going to be the whole market. And I have no idea where that endpoint is, if there is one.
So I have a question about our Canadian index market. So our firm converted to index philosophy in the mid-90s. So we lived through, and I'm curious your perspective on the uniqueness of perhaps the Canadian market, where the late 90s, we know what happened to Nortel. I think it became over 40% of the index, I believe, right? Can you talk about, that's just one example of indexing in a smaller market, but maybe talk about that experience as well.
All right. Well, yeah, we do indices in Canada, and actually we have an index committee up in Canada. We have an agreement with the Toronto Stock Exchange, and as a result, the committee has members from the stock exchange on it, as well as S&P members. S&P has a majority of the votes, but it's not like this. I mean, we're very collegial, not just because it's Canadian, but in general. I guess a few things that stand out about the Canadian market. First of all, it's pretty much focused on finance and natural resources and so on, and that's the nature of the Canadian economy more than anything else. The financial sector seems to be reasonably stable, or quite stable, compared to a lot of other financial sectors, including the one down here, and so on. The whole idea of diversification is a little bit different, and that kind of thing. Some of the stocks are cross-listed in the U.S., especially the large cap index, the S&P TSX 60, and so on. I guess the other thing is the index, that the principal index for most Canadian investors is the S&P TSX Composite, which is around 225 stocks at this point, and is a pretty big chunk of the market. It's compared to, say, the 500 positioning in the market in the U.S. or other markets that we look at, and so on. In fact, we built a 60 stock index, the S&P TSX 60. The idea of it was sort of an analog to the 500. But, so clearly the composite is a much broader sweep of the market, and so on. Probably gives a little more diversity. It's certainly a little more diversity than the 60. I mean, the 60 tends to be, even with a lot of work by the committee, tends to be very heavily financially oriented and that kind of thing. The other thing about the composite is the rules for the bottom, which is unusual. Most indices, either any stock above X billion dollars or, certain number of stocks. But the composite rule is the smallest stock can't be more than, I think it's now 1.5%, 1.5 basis points of the total weight of the index. It's sort of you get a tail, and how far down you go depends on the composition of the market.
But it's still market cap weight.
It's still market cap weighted, and so on. The other kind of thing that I think one sees when you look at small markets is investors who want a lot of diversification are more likely to look outside their home market than they are, in a market like the U.S., especially since, probably half the revenues of the S&P 500 come from outside the U.S. And a U.S. investor can be globally diversified without buying any non-U.S. stocks. I think for a Canadian investor to be able to say the same statement, it would be very difficult, especially because it's, going to be heavily weighted in natural resources and finance, but a lot of other areas, the weighting's not going to be that diverse or something like that. And you'll own, one consumer goods company instead of 3 or 4 consumer goods companies, and various other things, industry by industry. So there'll be those kind of differences and so on. But I guess the other thing I should say is working in the Canadian market has always been very interesting, and there are a lot of very large, substantial, well-respected institutions. Some of the big pension funds, I think, are much more active in Canada than their equivalents are in the United States, and that kind of thing, and so on, which I think has generally been beneficial to Canadian investors.
There was just a big report in Canada on the Canada Pension Plan Investment Board and how their active strategy has actually done quite well over the last little while. We're a bit skeptical of the report, but anyway.
I guess over the years I've met with them. We Americans go to be jealous. Canada's pension plan, they actually got real money instead of just book entry items and so on.
There's a big pile of money, that's for sure.
The other one that that I've seen bits of and so on is in Australia, where it's all equivalent, similar to American 401k plan, except the amount that you invest is substantially higher, so that the so-called superannuation plans, they have asset levels that would amaze some Americans.
You mentioned equal weighting, and we've talked a lot about different market cap weighted indexes. What are your thoughts on factor weighting? So weighting for value or small cap in excess of market cap weights in index construction.
Factors is probably sort of the current generation of ETFs and designing indexes in many ways. We went through a lot of arguments going back, I guess starting about 2004, 2005, about market cap weighted indices. People started to understand what happened in the tech boom and so on. They realized that the weighting for the S&P 500 for technology stocks got up about 33, 34%. We actually were underweighted compared to the market because the ones that didn't make any money, we never put them in the index. So all the stories about pets.com, if there ever was such a company, never got in the index. So that doesn't mean we knew what was coming or anything, it just means it never got in the index. But I think the factors do make sense and so on. And there are, certain markets where certain factors do very well. I don't think there's one factor that works all the time. Value and small cap may work a larger percentage of the time than many others. We've done a lot of work in low volatility stuff at different times, but it does, if you're going to do factors, you're going to do rotation and shift from factor to factor, you're taking one step away from being 100 absolutely passive to making some decisions, and sometimes you'll do better than the benchmark, and sometimes you'll do a little bit worse than the benchmark. It's not like stock picking where you could be miles away in either direction. And so on, but there is some of that goes on. But I think it's here to stay. It generates a lot of interest.
Do you think there's an obvious line? And I know we all agree we don't like the term passive investing, but I'm going to use that. Is there a line where we go from being passive to being active? Where is that line?
It's hard to have a particular line. It's sort of a gradual continuum or something like that. It may come into the question of should people, how far down that path should you go, or should you be a stock picker or not be a stock picker or something? And I think part of it is, for individuals, and this is not for financial professionals, and it's not for people sitting in offices with 10 data feeds coming in and 6 screens. This is for the regular ordinary people. Investing for a lot of people is a form of entertainment. There's nothing wrong with that. And maybe you think you get bragging rights, or it gives you something to talk to people about the barbecue or whatever it is. But it is some of that. And so maybe the way to look at it is, if you have to strain to look at your brokerage statement once a month and that's it, you don't want to have to think about this. You want to make sure the money's there. Buy a nice plain vanilla market cap weighted index fund from a reputable company. Most of the time you don't have to worry about it in a month. And if the newspaper articles are covered with black ink and blood before that, you got a problem. But that's it. But for the people who get some interest and benefit from it and so on, then they'll move down. And factors is, I think, a good way to look at things, and without spending 6 nights a week, 3 hours a night doing research on stock names or something, which I don't recommend, and that kind of thing. So, but it is sort of a long continuum, and I don't know where I draw the line. Most people say factor-based indices, whether it's for selection or weighting or both, that's index-based investing. I think that's reasonable.
I have a perception that most people are more aware of the brand, the Dow Jones Industrial Average, because that's what shows up in your feed on your smartphone. It shows up in the nightly news. Although the S&P 500 may be more money invested following it. And the Dow Index, as I understand it, used to be decided upon by the editors of the Wall Street Journal, but S&P and Dow Jones have merged, correct? You talk about the contrast of two, and
without going through all the corporate rearrangements and everything and that kind of thing. In 2012, up until that time, was S&P's index business, and combined with up until that time had been Dow Jones index business. Came together as one, and in putting it together, the marketing guys decided the name should be S&P Dow Jones Indices. I guess Standard & Poor's Dow Jones Indices, that you would have hung up the phone before we got halfway through or something. So that's how we came about. First, I should say, it's been very successful. A lot of mergers, the good guys and the bad guys you don't know who's who, and they hate each other all the time. That's not the case here. Very rapidly, I think we all got along, we all got together, and that kind of thing. The only slight disappointment in that category is the gentleman who was my equivalent on the Dow side chose to retire, and he and I actually knew each other long before the merger happened, just by running into each other at industry events and that kind of thing. So I was sorry that he retired, because it would have been fun working with him and that kind of thing. The perception of the indices, I think, were different in 2012, and they're probably still different now. The Dow, first of all, goes back to 1896. It has an unusual calculation method. It's price weighted,
it's very unique.
Well, I think the Nikkei 225 in Tokyo does it the same way, but I'm not sure I can verify
the higher the
that.
price of the stock, the higher weighting it has.
That's right. You could do it in the back of an envelope, literally. Take the prices of the 30 stocks, add them up, but instead of dividing by 30, divide by what we call the divisor, which is around 0.1 at this point. But that's Dow. And yes, that stock, I don't know which is the biggest stock on the top of my head, but Boeing used to be very high up. It may have not be so high now. The biggest stock is a couple $100 a share, and the smallest stock is $20 a share. Well, it doesn't matter what the heck the $20 a share stock does at that point, because the $200 share is going to carry the day. Why? Well, back in 1896, that was the way they did it, literally. It was 12 stocks then, and it was an average. And that's why it says Dow Jones Industrial Average in the name. I used to kid the fellow was my counterpart at Dow before we were together. What the hell you do it this way anymore? Why didn't you change? Get it modern. Anyway, me say, David, we got data going all the way back to 1896. Will you throw it away? And I'd say, yeah, I guess I wouldn't. And, well, now I got to talk to myself about that, I guess. But that's really how it came about. If you plot the two of them over long periods of time, not a day or a week, say 10 years, they're going to track each other very closely.
Which is amazing for such a really drastically different index.
Yeah, and a different weighting scheme, and so on. The 500 is 500 stocks was created in 1957, and it was S&P had always had industry groups and sub-industries and so forth. In fact, there was a weekly index from 1923 with industry groups for about 200 and some odd stocks. The 500 had always been really designed so you could use it to analyze the market more than anything else. And that's why it had, companies broken into industries, and there were indices calculated for all the different industry groups and that kind of thing. And all of that was done to make it useful for analysts. And S&P, when they created it in 1957 from an old 90 stock index, was in the business of selling stock market data, and it was designed for that purpose. So it grew up as being the more institutional, more analytical, more professional kind of an index. Dow grew up to sell newspapers, and Wall Street Journal is a great newspaper. So that's how they came up. The peculiar thing is that you turn on CNBC, you see the Dow, and then once they get past a few other odd indices that aren't ours, they get to the 500. We say, what happened to you guys? But that's sort of the background that in the way they grew up. Today, we have the committee that runs the 500, and a group of other U.S. indices is separate from the committee that runs the Dow. And the committee that runs the Dow still has 2 representatives from the Wall Street Journal, 3 from S&P and 2 from the Journal. Very much the same. The Canadian stock, the S&P TSX committee, is got people from the Toronto Stock Exchange and so on. So and it continues. And
I can only imagine the debate when you decided to remove GE from the Dow.
I think the best way to say is that any index has been around for a long time, and both of these have been around. The 500 goes back to 1926, so maybe it's the junior member, but it's not that junior. there is a sense of the way it's going to be perceived in the history and that kind of thing. And there was a lot of discussion. GE had not continuously been a member of the Dow since 1896, because if you go back to the very early days, they were really active stock pickers. If you look at the history, stuff came in and out a lot up until probably the First World War. I mean, for the first, let's say, 20 years of that index, there seemed to be a lot of activity. And I don't know why. I've never found I never found the right history book or something to tell me that, but I've seen the list of the ins and outs, which is, I think, up on our website too. You go back to the idea that it's supposed to be representative of the U.S. market. Clearly, the Dow has changed. It's no longer 100% industrials. It's still, the rules, which are also published, still say no utilities, no transports, because there are other indices, Dow indices for those. But it changes and keeps up with the time too.
You mentioned earlier that you don't think the whole market will ever be indexed. Do you think there's a point where indexing can get too big?
I'm not sure what would make it too big or something like that. From the point of view of the average investor, I don't worry about it. I mean, first of all, we talked before, I don't think it's going to squeeze out active managers. In fact, if anything, if more and more of the market is predictable because it's indexed and indices are transparent, then probably the active guys have a small leg up from that. I think what it's done for the average investor, certainly in the United States, because I understand more about the U.S. than other countries, but without defined benefit plans and with Social Security funding that, aside from this morning's newspaper that, again, says they're going to run out of money in 15 years, but very few Americans can live on their Social Security. That's the unfortunate but honest truth. So being able to save and invest is really important. And index investing, I think, has been a huge plus for that, for a lot of people that way and so on. So in that sense, I don't think it gets too big. And I think there's cycles in everything, so that either some other investment idea will come along that will pick up a lot of what index investing and ETFs do now, or there'll be some other shift or something like that. But the rate of growth is likely to slow down just because, you can't keep growing at these kind of breakneck paces forever. And the FT did have an article within the last couple of days that pointed out that on a global basis, money came out of ETFs in the month of May for the first time in, I think, 3 years. It'd been a down month. It didn't make a very big dent, but it did make a headline.
You've mentioned the average retail investor a couple of times and how great indexing is for them. For that type of investor, they're trying to achieve their retirement goal or whatever it is. Do you think, other than entertainment, which you mentioned, do you think there's any logical reason for them to do active management? I
don't want to say no, because then somebody will come after me for this one. But the way I'm picturing this individual is that it's not that they're not intelligent or anything like that, but it's investing in finance and economics is not their business. And in a sense, maybe the best sort of odd analogy is, I'm not a medical doctor, and last time I took biology, I think I was in 10th grade or something like that. So when I don't feel well, I go to the doctor, and I go to the doctor once a year to get a checkup and so on and so forth, because I'm not a medical professional. In the same sense, doctor's not a financial professional and that kind of thing. And, he or she ought to look for, when they need the expertise, to look for it that way. So you want to be a good stock picker. If you imagine you're the next Warren Buffett, well, you better go to Columbia Business School like he did, and spend the next 70 years working at it or something like that. That's why I think for sort of somebody who doesn't really have the financial background and skills and doesn't have the motivation to do it, they're probably better off doing something else. And, I agree that there are people who like to do it for entertainment, and some of them may do it by asking the next guy in the subway, "What'd you buy this week?" or something like that, which is probably not the best way to pick stocks. But if they want to do that, that's fine too.
So my last question for you: I mean, you've had a very impressive career and been at the heart of some very interesting work in a big, fast-changing industry. I'm really curious how going forward, and you're on the verge of the next phase of your life starting this summer, I believe, right? How do you define success for yourself going forward from here?
Yeah, I'm not sure I have an absolute answer and so on. I mean, the long list of things I like to do: travel, go see this place, go to see that place, spend time with my wife, my kids, my grandchild, all that kind of stuff. But I don't think I have this sort of specific thing. I got to do this, and this. But usually the question I get, we have sometimes I have, college groups come in or something like that, is, how do you count getting where you did, or, what was the success points and so on. And my story, for better or for worse, it's dumb luck to be in the right place at the right time. And it sounds silly, but when I came to S&P, I worked at McGraw-Hill, which was then the parent company. It's long since ancient history. I came down to S&P, and what my goal was to survive as the chief economist for the first year or two, and hope that the forecasts weren't so bad they were stupid. And roll forward about 15 years, somebody gave me a nice award for it, so I figured I managed to get that far. On the other hand, I figured they weren't going to get much better. So when sort of the index business came knocking at the door, I opened the door in a big hurry. I mean, and I guess at that point, my goal was I'd figured out after 10 to 20 years in business that if you wanted to make more money, you better be in a piece of the firm that was growing quickly. If you're in a piece of the firm that's not growing, that's, no matter what they say, you're not going to get as big a raise as you were in the fast growing spot. I guess I wanted to pick indexing as being the fast growing spot at the right moment and so on. But so I don't have any absolute goals, but the last 38 years have been a hell of a run. If we get the next 38 or even 90% they're good, I'll call it a success right there. So
that's usually our last question, but I've got one more to follow on what you just said.
Yeah, you may want to edit some of that out because that was sort of rambling.
No, that was great. I don't think we need to edit it. You talked about you got into the indexing business at the right time. Can you just talk a little bit about the effect of the growth of indexing on S&P?
I haven't worked in a lot of other companies. Out of graduate school, I worked for an economic consulting firm for about 3.5 years. Was a time when I knew about litigation, environmental rules, but there were different rules back in the late 1970s. But the scale is hugely different. When I came to S&P, there were fewer people in the whole company than are in the index business today. Probably 400.
There were fewer people in the whole company
than in the index business today.
Wow.
Now, back in 1982, the U.S. was emerging from a horrendous recession, a decade when the market did nothing. Everybody says, so why the hell would anybody even go down to Wall Street or something like that? Fed funds rate was probably about 14% in the first half of 1982. Why would anybody buy stocks? By the way, the inflation rate was probably about 13.5% and so on. We were still in the second of two back-to-back recessions. One ran about 6 months and the next one ran about a year, maybe a bit more. Jimmy Carter had lost the election by appointing Paul Volcker to the Fed, who then jacked interest rates through the roof and shocked everybody. And then it all took off. So I think we woke up with a big shock in late 1982. The first thing that happened to the index business was it started to make serious money because of the S&P 500 futures at the CME, not overnight, but certainly within a couple of years, it was making serious money. And that made a big difference right away. It had to expand to a certain extent just because there was more work to be done because of the futures and so on. The first index that was added was what's usually called the OAX, the S&P 100, with the basis of the original index futures on SIBO. That was actually created by SIBO, and they couldn't figure out how to run the index, so they gave it to us, in effect. And we didn't really add a second index of any substance until the early 90s with the mid-cap index and so on. So from 1982 to, let's say, roughly about 1997, it was gradual growth. The size of the group expanded. It gradually became a little more formal and structured, but, probably went from, 5 people to 12 people to 25 people or something like that over that period of time. When I became head of the index committee, which was in 1995, I think there were about 15 people who were officially part of the index group. I wasn't. I was still being paid by another group. And I had 3 people work on indices who were also being paid by some other group in the firm. So maybe we had 20 people altogether at that point. We went through a series of management shifts through most of the 1990s and so on. In, I guess, 97, we had a new senior manager come in who looked around and said, we should look further afield than the United States. And Canada was really the first thing we did. But between then and, in rapid order, S&P indices opened operations in Canada and Canadian Stock Exchange, and Australia with the Australian Stock Exchange, acquired emerging market indices from the IFC, a division of the World Bank, acquired a global set of indices from Citigroup, which they'd originally been built by Salomon Brothers, and they went through various name changes. That took us up to about 2005. Then we acquired commodity indices called GSCI. GS stood for Goldman Sachs. It was originally Goldman Sachs Commodity Index, now just GSCI. So in about 10-year period, we went from 3 or 4 indices in the United States to people based in, I'm not sure I can list all the countries, Toronto, Sydney, Australia. We had a group in London, even before we were doing indices in Europe. We had the emerging market indices, and it just sort of blossomed. We were in the commodities game and figured that out, and so on. So we expanded very rapidly, and the timing was right, because it was the same period when the investment world discovered the idea of investing with indices as ETFs started to grow and everything, and it came together. So by the time you rolled up to 2012, when we joined with Dow, we gone from, people would say, Standard Who to S&P. I mentioned the blog piece in the history. What it reminded me of, when I came to S&P, the equity research group used to publish these little one-page reports on every stock, and they had 3 huge sets of volumes: New York, Amex, and OTC. Amex that was the American Stock Exchange. They were called tear sheets, or they were called S&P. And I think right after I joined S&P, I went out to theater one night, and there was a play called Other People's Money, and the villain in the thing who was trying to buy out 6 companies yells, "Give me the S&P." He wanted the tear sheet. Nowadays, the S&P means the 500. So that's sort of the evolution. That's what happened to all the stock pickers too, I think.
Right. That was a fascinating little history.
So,
well, Dr. Blitzer, this has been phenomenal. I can't believe how much time has passed.
Yeah, this has been an amazing voyage.
Flew by.
And we learned so much. And for you to be so gracious to welcome us into your boardroom overlooking Lower Manhattan is, I must admit,
you should have come on a clearer day and so on. You can't see much of you.
It's quite an experience, I must say. And yeah, thank you very much.
Yeah, I agree. Thank you.